Hey everybody, it's Victor Medina with Palante Wealth Advisors, and I'm recording this on the morning of March 14th, 2023, and it's just following the collapse of Silicon Valley Bank and its related retail banks. And there's been a lot of questions that are going around about whether or not this collapse signals any concern for just a general investor or people that have money in other banks, and then specifically for our clients, the people that have money at Schwab, and whether or not that's going to be affected at all. So what I want to do is record for you today about, I don't know, maybe a 5 to 8 minute video that's going to provide an overview about 3 different areas. First, how did we get here? What happened? So you get some context of that. Second, why your investments are safe, and third, why your cash is safe as well. And so if you got questions that follow this video, go ahead and respond to the email where you receive this, and we would be happy to give you some more information. And if you know of anybody that wants to get some context on this as well, you can feel free to forward the email where you got this or forward this video to them so that they can have that information as well. So let's start with number 1, which is sort of how it happened. Now, to kind of understand what led to the collapse of Silicon Valley Bank, we need to understand first the difference between assets on portfolios that are known as held to maturity, which is HTM, versus available for sale. Now, held to maturity is something that when the change of the value of the securities that are on the bank's statements, when that changes, there's no need to update what the bank valuation looks like because they're not available for sale. They're held to maturity. And so the ups and downs of the particular value of that do not cause the bank to have to update its value and update its statements. However, when you have things that are on bank statements that are available for sale, while it provides the bank a lot of flexibility in terms of being able to sell off assets along the way, you have to change the value based on whatever the market is for that particular security. One other thing to know about this as a regulatory matter is that when you switch something as being designated from held to market to available for sale, you have to go ahead and change the valuation as well. So at any point in time, banks are investing some of their money in things that are, well, first of all, they're holding it for cash, but they're also investing in things that are going to make back some money, and they get to designate whether they're held to maturity or available for sale. Now we get to the next layer of this, which is we're talking about mortgage-backed securities all over again. And so mortgage-backed securities are thought to be sort of a set of the most secure things that you can have your money in. It's secured by the interest in real estate. Real estate values tend to be stable. And if we put aside all of the nonsense that happened in 2008, banks and other investors are still regularly investing in mortgage-related securities. And so whether or not those are on an institutional basis, whether or not there's lots of variations of it, but the point is that you can, and banks do, invest in mortgage-related securities as part of their portfolio. It's not necessarily a bad thing, but when we end up seeing the rise of interest rates for mortgages so sharply as we did in the last year, in fact, that increase was one of the sharpest increase in mortgage-related interest. It changes the value of those mortgage-backed securities because the new ones, just the same way like bonds that are issued new that have higher interest rates are more valuable, mortgages that are issued new with higher interest rates are more valuable. And so what it meant was that if a bank like Silicon Valley Bank had money inside of its mortgage-backed securities and they were marked as either available for sale or switched from held to market to available to sale, as interest rates rose, the value of those securities went down, and that caused them to have to essentially report this lower capitalization, lower value rate. Last thing, changes in terms, oops, that's the wrong one. There we go. Deposits falling off at Silicon Valley Bank, and then I want to give you some context with respect to Schwab. So, for a long period of time, during COVID, from essentially 2019 to 2021, but a big part of COVID, deposits were off the charts, especially at Silicon Valley Bank. There's a lot of money that was going in because there's a lot of investments that were going in. But that ended up falling off and fall off really in this last year. So what that meant was that the ratio of deposits on hand, the way that the bank was growing in terms of new money, relative to the value of its portfolio ended up getting flip-flopped. And so what we had there was a situation where the bank now looked like it wasn't bringing on money, it wasn't properly sort of in a good liquid position, and then the value of that as a publicly traded security ended up going down. And so for those reasons, it led to sort of the collapse of that bank. Now, I wanted to juxtapose that between Silicon Valley Bank and what Schwab has been doing, because all of our clients' investments, if they're not with insurance companies, are with Schwab. And it turns out that in February, Schwab had one of the highest influxes of dollars on deposits. About $47 billion or so was deposited. So they're not like what Silicon Valley Bank is in terms of the way that they've been acquiring new assets. So that's a little bit of the context of sort of how it happened. I want to talk a little bit about why your investments are safe. So the first thing that you've got to remember is that when you have a portfolio of mutual funds, of ETFs, of structured notes, basically any security that you've purchased inside of your portfolio, up to and including a money market account, those are actually securities that you own. Bank doesn't own them. Schwab doesn't own them. It's not on their books as part of their valuation. They're acting solely as a custodian of those securities, and they help facilitate the buying and selling of those securities. So to go from Bob to Sally, they're going to go ahead and switch that between the two, but they serve as a custodian. And that meant that in the unlikely event that Schwab was to collapse as an institution, let's say it just erased itself and it completely imploded, you own the mutual fund. It's never Schwab that owned it. So your investments are completely safe no matter what Schwab does, because if Schwab were to collapse, then there would just be a new custodian to hold the record of your shares that are in these securities. And so that means that for the money that's invested, while the actual value of the funds may go up and down, it has nothing to do with the stability of Schwab itself. In fact, all of the funds that we end up investing in through Dimensional Fund Advisors and through Vanguard are highly diversified. No one portion of it is heavily invested in any particular sector, least of all number of banks that are in place. So first thing is that your investments are safe. The second thing is that your cash is insured. So Schwab, that's holding things that are not in a money market, but in fact in their bank, is acting as a bank under all of the regulatory structures of a traditional bank. And so what that means is that it is subject to FDIC insurance for that. And in fact, Schwab issued a statement on Monday commenting on the state of affairs. It's unusual for them to do that at all. They tend not to make any comments about what's going on in the market, but of course they were affected by the fact that banks were collapsing, and they wanted people to know that things were going to be okay. And so one of the things that they talked about in there, really sort of on a twofold to make people comfortable that they weren't going to require a bailout and that they weren't going anywhere, is first that 80% of the deposits that are on hand are in fact FDIC insured. So it's not 100% that's in there, because some people have limitations that have cash on hand that's higher than the limitations that are covered by FDIC insurance, but 80% of it is insured. And that's juxtaposed with only 20 or sometimes as low as 12% of cash that was on hand for Silicon Valley Bank as not being insured. So that's one of the things that's there. And second is that they have a tremendously large line of credit available to satisfy any runs on cash for people that do want to pull out their money and want to take it somewhere else. And I think the number that they reported was north of $80 billion that was available, which is going to more than cover if people wanted to go to Schwab and make a run on it. Now, what does this mean for you? First, I think this is just an interesting thing that's going on in the financial world. We're comfortable that you are not, in terms of investments, so heavily in one or more of the banks that are being questioned right now, and certainly not at all in a sector. We don't believe in sector-based investing, so we don't have to worry that the bank itself or the bank as a industry is somehow affecting our strategy. This kind of volatility is just something that happens from time to time, so I'm not particularly worried about the portfolio or the investment strategy. And so for that reason, I don't really advise any changes along the way. Second is that anything that's being held in cash or cash equivalents, whether we're talking about money markets, which are securities, or a bank, you have the Schwab bank sweep that's in there, that money is either insured or held as a custodian for you. And so even the cash or the liquid cash that's available is not anything that we're particularly concerned about or see for you as being any higher risk. So we're not making any changes on that front. Now, we're constantly monitoring everything that's going on, and we're constantly thinking about what's the best move. One of the more common things that we've seen is that bank interest rates, money market interest rates, have been higher than just a year ago. And so shifting some of the money into there for a period of time may be something that we're doing to help cash management along the way. But if you want to provide some or have some context for what's going out in the financial world with respect to the collapse of Silicon Valley Bank, you should walk away with two salient points. First, your investments are safe because they are yours. They're not the bank's, no matter who is the top of the name that's on there. And then second, your cash is insured, and we feel very comfortable with Schwab as a custodian. They're having a great number of influx of dollars coming in. They've positioned themselves in good spots to be able to satisfy any demands for cash or people that want to pull cash. So there won't be a run on that in the sense of it's seeming like it would be something that would be risky off of it. And so I think they're doing all of the right things and very comfortable with our clients' money that are there. Now, by the way, those of you that got money in insurance carriers that are out there, they're not affected at all. They're not a bank. While they don't have FDIC insurance, we've only selected carriers that are financially strong and carry a lot of cash on hand to satisfy any requests for dollars. But I don't foresee that there's anything that's going to be going as a run on banks or a systemic failure somehow in that area. I think that you should look at this kind of like an interesting thing, but beyond that, not feel like it introduces any particular risk to you, especially the way that we have structured your investments. If you're watching this and you're not working with us because a friend shared this with you and you'd like to know more about our services, see how we might be able to help you with your retirement planning, feel free to reach out to victorpalantewealth.com. That's P-A-L-A-N-T-E. wealth.com. We'd be happy to have a conversation with you about maybe you like what we're talking about and you want to work with that. But other than that, if you're a client, if you've got any questions, don't hesitate to send me an email. I'll be happy to jump on a call with you or reply to that email and talk you through what we're seeing here. I hope this video has been informative, and we'll talk to you later. Bye-bye.
Hey everybody, it's Victor Medina. Thanks for watching the video. If you want more great information on legal and retirement planning, make sure you hit the subscribe button so you get notification every time we post something cool.